Good morning and good afternoon, everyone. My name is Roger Nieves. I'm joined here today by Dan Ivascyn. So it's been quite a choppy start to the year here in 2022. What should financial advisors be telling their clients about the outlook for the economy right now?
Sure. Well, you're absolutely right. It's been a choppy market environment in an environment with tremendous amount of macro uncertainty. Various cross currents, COVID reopening, which is a positive scenario for the economy, but it's leading to some pressure on prices given existing supply bottlenecks. And although we anticipated a lot of volatility this year, didn't anticipate war on the ground in Europe, which is quite significant, of course, both in terms of more base case scenarios, but also the type of more extreme uncertainty that now creates across the global economy, particularly in Europe. But with bombs falling and risks around NATO engagement and expansion of the conflict, it's really, really challenging, for investors who, of course, are dealing with a high inflationary environment as well. So I think the bottom line from an investment perspective is to have a healthy degree of humility, realize there's going to be a lot of volatility, a lot of uncertainty, and just be careful in sizing positions. Be careful about being too overconfident regarding markets. Anytime you have this uncertainty in central banks tightening policy as opposed to loosening policy, you could have significant overshooting, and that can be a great opportunity for the patient investor, but it can be a quite troubling time if you are overconfident, if you're taking excess risk relative to your own personal financial goals. This is an environment that can create some damage. So bottom line, we expect more uncertainty, more volatility. That's great from an active asset management perspective, but you also need to respect the fact that things can get a lot worse before they get better, both on the inflation front and then even some concerns around economic growth. But valuations are looking more interesting, and finally we have some yield and some spread to get a little bit excited about, but it'll be a choppy market environment, certainly going into year end. So
yields are better, as you're saying. And hopefully bonds are still in a really good position to provide that capital preservation in investor portfolios. And then the benefit that we often speak to financial advisors about is diversification to equities, right? Which struggled a little bit earlier in the year, but more recently, right, we've started to see a little bit of that diversification come back into the bond market. Do you think that bonds are still well positioned to be that diversifying force in the 60-40 portfolio? We know a lot of advisors have been receiving emails that say the 60-40 portfolio is dead, but that may not necessarily be the case.
Yeah, so we don't believe 60-40 is dead. But your specific question of the role of fixed income as a diversifier over the next few months is a tough one to answer. There's a lot of uncertainty there. But you're absolutely right. It appears that rates have gone up fast enough and to a level now where you're beginning to see people become more concerned about a recession, more concerned about equity valuations, equity earnings. So you have seen the scenario now where over the course of the last few trading sessions, when stocks have gone down, bond prices have gone higher. So we do expect to get back to that more traditional relationship soon. And I'll define soon as over the next year or so. It can happen sooner than that because there is this very strong linkage between the real economy and the financial economy. And we've seen prior economic slowdowns be driven by weakness in risk assets. And we very well could see further weakness that leads to a further tightening of financial conditions to slow the economy on its own. But now that inflationary risks are the primary risks people are focusing on, and you get more concerning high inflationary prints, you could quickly swing back to that bad correlation environment that we've been in for much of the last few quarters, where stocks sell off, bonds sell off, and that's where, again, the traditional 60-40 doesn't, of course, work well under that scenario. So this is, again, a journey towards a time when inflation gets back within reasonably acceptable ranges for central banks. We as a firm are fairly confident that over the course of the next year or two, we do get inflation back to more reasonable levels. And when that occurs, when other participants believe that that trend is beginning to form, then I do think you'll begin to see that more traditional correlation return, where down equity days likely coincide with up bond prices, or at least at a probability, closer to what it was just a few years ago. But a lot of uncertainty over the short term.
Dan, thank you very much for your time today, and thank you to all of you for joining us for our discussion. For additional information, please visit us at PIMCO.com.